Welcome into Clear Picture Financial. Again, your host, Jason Noble. You can find him at Prime Capital Investment Advisors. Check him out online, clearpicturefinancial.com. Jason is a fiduciary advisor, holds his FINRA Series 66 securities registration, certified financial planner, and a retirement income certified professional with, get this, 18 plus years in the financial arena, helping his clients get ready for retirement. I'm Morgan Patrick, consumer advocate, and I tell you, Jason, it is every single week. We get into so many different topics. So this is an interesting one. Big money, no whammies. All right. Brings back memories of the game shows in the 80s and the 90s. Don't give up on the stock market. A lot of people are nervous right now.
Yeah, I understand. And, you know, when stocks are falling, it's something to give up on the stock market for retirement savings, and don't. Keeping your long-term retirement savings invested is one of the only ways to really keep up with inflation over a long term. Just hanging out onto like funds invested in S&P 500, return about 9.9% annually on average since 1928, says the index fund advisors. The average return outpaced the average long-term inflation by more than 200%. Additionally, for long-term retirement money, today's depressed stock prices are actually a blessing. They'll be able to buy more shares that you could have in 2021 for the same investment amount. So this is so important. It's called dollar cost averaging, and it's something that you would be doing in your 401k, 403b, 457, but also you could be doing this in your brokerage accounts as well.
Tell you, and again, people are nervous, and understandably, we've got a lot of stuff going on. The latest news with bank failings, people are very, very concerned. So, you know, they're looking for options for their retirement dollars, and we're just kind of going over a few things that you need to be aware of. You know, don't give up on the stock market. You know, keep your money in there, but also just be aware. Make sure you're planning. Some of that is safe, obviously, and then avoid timing the market. People think that they can do this, Jason. This is scary stuff.
Yeah, well, savvy investors know when to look for investing in individual stocks, but the long-term retirement savings money is often best to avoid trying to time your contributions, because you'll likely get the timing wrong. If you stop contributing to a retirement savings account, it's tough to know when to resume and get back in. So many people don't resume, and when they do, it's too late. So getting hung up on perfect time into the market really doesn't matter much to long-term retirement savings. And Schwab found that investors who simply invested $2,000 annually at the end of the year for 20 years in the S&P 500 from 2001 through 2020 round up with $135,471. So that's only 10% less than $151,000 that would have been if someone remarkably invested that $2,000 at the perfect time in each of those 20 years. It's an impossible feat for most people to know without having that crystal ball or tomorrow's newspaper.
Tell you, we talk about retirement planning each and every week here on Clear Picture Financial, and you're going to have this plan to get you to retirement, but not just to it, through it. And people are concerned about running out of money in retirement. So things that you just need to be aware of, don't give up on the stock market, even though it's a nervous time. A lot of people, and I should say, they're considering what they're going to do with their money. Really, talk with a professional, a fiduciary about your retirement plan and come up with this roadmap to get you to retirement. And I would almost guarantee you that, you're going to keep something in the market. You may move some stuff around. Now, what about the cost of waiting? This is a big one.
Well, and the trouble with trying to time your long-term retirement savings contributions is not just improbable, but it's paralyzing. If investors sat on their hands waiting for the right time to invest that $2,000 that I was talking about and clung to cash, they would only have about $44,400 after 20 years. And this is what Schwab found. That is 67% less than the person who bought annually without trying to pick the right timing.
Tell you, folks, just having that plan and talking over these different scenarios. And when I say scenarios, the what ifs. What if this happens? And then you plan for that as you move towards retirement. So here's a question for you. How much to save and invest?
Well, how much did you put into your retirement savings, really? Well, no amount is too small. And I think sometimes you just got to get started if you haven't started already.
Okay. Well, let's talk about what Mike Shamrell is talking about. Again, Fidelity Investments Vice President, thought leadership. He's right there. He's got some guidance. And again, this is just information that retirees need to know.
Well, he came out and said that, the firm, Fidelity, encouraged a 15% annual savings rate, which included contributions and the employer match. And I would say 15% is really just a start, okay? And the reason why I'm saying that is that if you're listening and you're under the age of 50, you have a lot of headwinds that are facing the threats of Social Security system and Medicare reform, meaning that's going to put more pressure on you to save more. Now, let's say if you're over the age of 50, well, then this 15% mark is just, again, like a guideline, because if you've been saving since you were in your 20s and 30s and now you're in your 50s, over 50, yeah, saving 15% could, in high probability be in line. It really depends on like what your expenses in retirement are going to look like. But I had couples that have come into my office that, in their 20s and 30s, they were paying off debt. They were helping their kids' college, paying for their own college.
Sure.
And they got a late start, and they can't save 15%. I mean, one couple that comes to mind, they got to save about 23% to be on track to reach their retirement goals. So if they did 15%, they will fall vastly short, or they would have to make significant changes to the retirement plan. So I will say this is a start. So I'm not throwing shade at Mike here. I'm just saying it's a start, and it's a good information for the masses, but you really got to look at your personal savings rate for your financial goals.
Well, let's just take a step back here, Jason. I mean, how do you help your clients stay on this track for retirement and with what we're currently seeing with the economy and just the market environment?
I love this. This is the question that really matters so much, right? And I'm going to quote Proverbs 27:12. It states, "A prudent person foresees the danger ahead and takes precautions. The simpleton goes blindly on and suffers the consequences." Now, you must enter into retirement planning with the end goal in mind, meaning retirement planning is not just about climbing up that mountain, but it's also how do you get back down.
Yeah.
So we're going through this with my clients. We put together their retirement plans with the end goal in mind and not just going blindly up that mountain. If you are climbing up a mountain, right, I'm talking to you listeners right now, and if you got a guide, would you want that guide to know how just to get up the mountain? Probably not.
No, I want up and back.
Yeah, so you got to make sure you plan accordingly. So before you even take that journey, and this is where I'm working with my clients, no matter where they're starting at when they reach out to me, it's my job to work with them. And this is where we discuss the 3 Ps with our clients: public, private, and protection. In my nearly 2 decades, I found that people's risk tolerance reflect what's going on in the current market. And if you're really thinking about it, listeners, when the markets are down, this is when you're filling out a risk profile. The typical answers are more conservative than when the markets are up.
Right.
This is not the best case, though, as it pays to stay the same or even go more aggressive when the markets are down. Warren Buffett once said, "Be fearful when others are greedy and greedy when others are fearful." So through our clear picture analysis, we focus on the assets and where they're located between public, private, and protection locations.
Okay. Well, I mean, that's a lot of That's a lot of P's. So let's do this. Now, you somewhat gone over PPP, on other shows. So what exactly do you mean by PPP, and tell us how that works?
Well, P for public offers liquidity, more volatility though, and what this means for you is if you need money, this is the first place that you will go. But we have to have the right risk profile so that you can sleep well at night. But we believe we can add a layer of risk transfer so you benefit to you is that if you could take a percentage of your portfolio and add a couple of rules to it within the protection allocation, what that can mean for the overall risk profile. The protection allocation is where we take precautions, going back to Proverbs 27:12, right? We take the precautions for the dynamic markets that we're looking at right now. We address this within our clear picture analysis. We look to see how we could transfer that risk to somebody else's burden, for someone else to really burden that risk for us. Now, that somebody else could be insurance companies, or it could be something more complex like hedge funds or structured products. I would just say that's rather complicated for our conversation right now, Morgan, but you get the point. The benefit for our clients is to still participate in upside potential, but transfer that risk to someone else. Now, if you're listening and your current advisor is just talking about risk tolerance in the public markets, that is simply not enough. Listen here, right now we are helping those that are losing confidence in the economy and the public markets as a whole. So allow us to talk about some ways that we can still have upside potential but with somebody else's risk. Now, if you're interested in that strategy, those are the listeners that we want to talk with, and they should reach out, Morgan.
Well, let's get that done. We have spots on the calendar. Again, this is with Prime Capital Investment Advisors, where you can find Jason and his team. We have a limited number of spots, 10 total for the show. So what's going to happen for these 10 lucky callers, Jason?
When you call our office, Justin Green will answer if he's not on the phone with another caller. He will call you back as soon as he can to schedule an introductory call and a core values meeting. We want to get to know your story. We want to get to know the story of your money, your goals, your aspirations, and what your concerns are. That's where we start to build out the clear picture analysis, taking a look at what's going on within your investments. We look at building out a risk-first approach, because we could do that with the 3 Ps, right? Private, protection, and public. So this is the way that we go about working with our clients, building a holistic plan around their financial goals. And if that's something that you're interested in, that's who we want to speak with. Reach out. Morgan, how can they schedule these conversations?
All right, we have 10 calendar positions. You can call this number. There are 2 ways you can do this. You can call this number, 843-743-2926. Again, the number, 843-743-2926, or you can text NOBLE to 600-700. Again, that's NOBLE, N-O-B-L-E, to 600-700. Again, this is an opportunity to kind of kick the tires, get to know Jason and his team at Prime Capital Investment Advisors. It's no cost, no obligation, simply no pressure. This is a no-brainer, as they say. And, if you have not started planning, this is a great opportunity. If you are in the middle of something and you just have questions and that feedback's not there and the communication's not there, it is time for a second opinion. Call the number now. Grab one of these 10 positions. They will go fast. 843-743-2926. Again, 843-743-2926. Or you can text NOBLE to 600-700.